Building a winning portfolio is not about picking one best stock. It's about combining assets that work together to balance risk and return. Portfolio theory explains how combining different assets creates a structured way to optimize performance and reduce uncertainty. The expected return of a portfolio is the weighted average of individual asset returns, where each weight represents how much you invest in that asset. By changing these weights, investors can control the return profile of their portfolio and align it with their financial goals. Risk depends on how assets move together, making diversification a key factor in managing uncertainty. The efficient frontier shows the best possible portfolios that maximize return for a given level of risk, turning investing into a data-driven process. The first step in building a portfolio is estimating expected return, which represents the average return an investor anticipates over time. The simplest method is the historical average, where expected return equals the sum of past returns divided by the number of observations. For example, if returns are 10%, 12%, and 8%, the expected return becomes 10% as the average. More advanced models like CAPM estimate return using the risk-free rate, market return, and beta, which measures sensitivity to market movements. Multi-factor models go further by adding factors like size, value, and momentum to better capture what drives returns in real markets. Estimating expected return is both an art and a science, requiring a balance between data, models, and real-world judgment. After estimating returns, the next step is measuring risk, which represents how much returns fluctuate over time. Variance measures the average squared deviation of returns from their expected value, showing how widely data spreads. Standard deviation is simply the square root of variance and gives a more intuitive measure of risk. Two assets can have the same expected return, but the one with higher standard deviation carries much greater risk. Covariance measures how two assets move together, forming a key component of portfolio risk. Correlation ranges from -1 to +1, and combining low or negative correlation assets reduces overall portfolio risk. When we move from individual assets to a portfolio, risk depends on how assets interact with each other. Portfolio risk is calculated using a formula that includes individual variances and the interaction between assets. Covariance measures how two assets move together, and it plays a critical role in determining portfolio risk. For example, consider two stocks with different risks and a positive correlation between them. When combined in a portfolio, the overall risk becomes lower than the average of individual risks. This proves that diversification reduces risk, especially when assets do not move together, making it one of the most powerful tools in finance. Diversification means not putting all your eggs in one basket, reducing the impact of a single failure. Diversification reduces unsystematic risk while maintaining exposure to systematic risk that drives market returns. Holding one stock exposes you to company-specific risk, while a diversified portfolio reduces that exposure significantly. Research shows most diversification benefits are achieved by holding around 20 to 30 well-chosen assets. As more assets are added, portfolio risk declines rapidly at first and then stabilizes over time. True diversification comes from combining assets with low correlation across sectors and regions, creating a resilient portfolio. In investing, higher returns usually come with higher risk, creating a fundamental trade-off every investor must face. This relationship is measured using mean variance analysis, where each portfolio has an expected return and a level of risk. Some portfolios dominate others by offering higher returns for the same risk or lower risk for the same return. Risk-averse investors prefer stability, while risk-seeking investors accept volatility for higher potential returns. Portfolio optimization finds the best combination of assets that matches an investor's risk tolerance and return goals. Successful investing is not about chasing returns, it is about managing risk while achieving consistent long-term growth. The efficient frontier represents the best possible portfolios that maximize return for every level of risk. On a graph, it appears as an upward sloping curve in the risk-return space, showing optimal portfolio choices. Portfolios below the frontier are inefficient because better options exist with higher return or lower risk. The efficient frontier is created by minimizing portfolio risk while targeting a specific level of return. This visualization shows the optimization process, highlighting the portfolio with the lowest variance for the target return. Investors choose a point on the frontier based on their risk preference and return expectations. The efficient frontier transforms investing into a clear, structured decision-making process based on risk and return. When a risk-free asset is introduced, the efficient frontier transforms into the capital market line. The capital market line shows the best combinations of risky assets and a risk-free investment. The equation of the capital market line includes the risk-free rate, market return, and portfolio risk. The slope of this line is called the Sharpe ratio, which measures return per unit of risk. According to the two-fund separation theorem, all investors hold a mix of the risk-free asset and the market portfolio. The capital market line simplifies investing by showing the most efficient way to balance risk and return. The Sharpe ratio is one of the most powerful tools in finance, measuring return relative to risk. It is calculated as excess return over the risk-free rate divided by the portfolio standard deviation. A higher Sharpe ratio means better performance because more return is earned for each unit of risk taken. A portfolio with lower return but much lower risk can outperform a higher return portfolio when adjusted for risk. Fund managers use the Sharpe ratio to compare portfolios and identify the most efficient investment strategies. The Sharpe ratio shifts focus from chasing returns to maximizing efficiency through smart risk management. Asset allocation is the process of dividing investments across different asset classes like stocks, bonds, and alternatives. A common strategy is a 60-40 portfolio, balancing growth from stocks with stability from bonds. Younger investors prefer higher equity exposure, while older investors shift towards safer fixed income assets. Strategic allocation sets long-term weights, while tactical allocation adjusts portfolios based on market conditions. Modern portfolio construction uses factor investing to target drivers like value, size, momentum, and quality. Expected returns can be modeled using factor premiums, which represent systematic sources of return. Tilting toward value can increase returns, while focusing on low volatility can reduce overall risk. Risk management protects portfolios through diversification, hedging, and disciplined position sizing.
Investors use derivatives like options to hedge against potential losses during market downturns.
Value at risk estimates potential losses, helping investors maintain stability even in uncertain market conditions. Over time, portfolio weights change due to market movements, making rebalancing essential. Without rebalancing, portfolios drift away from their original risk profile. Rebalancing restores target allocation by selling winners and buying underperforming assets. This disciplined approach helps investors avoid emotional decision-making. Rebalancing can be done periodically or when allocations deviate beyond a set threshold. Rebalancing keeps portfolios aligned with long-term goals and risk tolerance. A winning portfolio combines diversification, risk management, and disciplined strategy. Investing is not luck, it is a structured process driven by data and strategy. Those who master risk and discipline do not just invest, they build long-term wealth.